Hi, my name is Adam Whitmer from ComplianceCohort.com. This compliance clip is going to focus on flood insurance for buildings with no apparent value. So the dilemma here is that sometimes a lender will have collateral that includes a structure or a building that is really worthless to the lender. It has no value for the purposes of the loan. So, for example, you may have a land loan of 100 acres in an agricultural deal where the land is what they're concerned about, but on the end of this land, you either have a barn or a silo that's technically a structure under flood insurance rules. And flood insurance rules say that you need to have flood insurance anytime you make, increase, renew, or extend a loan that's secured by a structure in a high-risk flood zone. So the dilemma is, do we really need flood insurance on these buildings with no value? Now, I've heard lenders give all kinds of excuses. They give excuses like not all buildings are needed as collateral, or not all buildings are assigned an appraised value. So the appraisal may say there's no value to them, or the building is worthless to both the lender and the borrower. And the biggest complaint of them all is no borrower wants flood insurance on these structures at all. The idea is if it were to fall down and get destroyed in a flood, nobody would care. Not the lender, not the customer. So what is the purpose of flood insurance? It is worthless. At least that's the argument. Now, from a safety and soundness perspective and the quality of the loan, that may not be a problem, right? There's no need for flood insurance if you don't care, right? If your land's worth $100,000 and the building's only worth $5,000 and your loan is only for $50,000, you've got enough in just the land. You don't need to worry about the structure. But from a compliance perspective, on the other hand, flood insurance may be needed, because what we need to do is look at flood insurance guidance to tell us what we need. The answer to our question on whether we need flood insurance on a building with no value comes from the Flood Insurance Frequently Asked Questions number 24. In this frequently asked question, the question is, it says, some borrowers have buildings with limited utility or value, and in many cases, the borrower would not replace them if it was lost in a flood. The question becomes, is a lender required to mandate flood insurance for such buildings? That's the question found in frequently asked question number 24 for flood insurance guidelines. The answer here is really two parts. So there's two parts to this answer. The first part gives us the answer and it says, yes, under the regulation, lenders must require flood insurance on real estate improvements when those improvements are part of the property securing the loan and are located in a standard flood hazard area and in a participating community. So the first answer is yes, you need to have flood insurance. Now, the second part of the answer is beneficial for some financial institutions, because what it says is that there is an out. It says the lender may consider, and I quote, carving out buildings from the security it takes on the loan. So basically, in your collateral, you could say we're taking all the land except for the buildings or structures, or saying the legal description, we're taking this except for this little piece. So you can essentially carve out the buildings or structures from your collateral. Now, the frequently asked question goes on to give a word of caution. It says, however, the lender should fully analyze the risks of this option. In particular, a lender should consider whether it would be able to market the property securing the loan in the event of a foreclosure. So, could you sell the loan? For example, if you have 100 acres and the structure was an old house right in the middle of the 100 acres and there's no way to access it except through the 100 acres and they get to keep that, how in the world are you going to be able to sell the land around it? Now, if it's on the very corner of a land, you might be able to do that. If they still own that structure, you may be able to still sell the land, but you have to consider that. Also, the frequently asked question number 24 goes on for additional caution. It says that the lender should consider any local zoning issues or other issues that would affect its collateral if it did carve out the structures. So that's an option for an out. Now, is it a good idea to do this every time? No, but if you have a customer who is really pushing back and causing a deal breaker, this might be an option for your financial institution. Now, are we done? No. That's why it's blank here, right? Are we done? No. So there's one more potential exception to the rule. And this, of course, is the detached structure exemption. Now, on the detached structure exemption, I have other videos and articles explaining this. So on the link to this video, I will give you a link to what you need to consider to see if you can utilize the detached structure exemption. That is another option if you're trying to not have flood insurance on a building with no value. Well, that's it for today. I hope you enjoyed this compliance clip. We have a lot more clips just like this. We have free videos and articles for our members. Membership is absolutely free, at least our basic membership is. So check us out at compliancecohort.com. Again, I'm your host, Adam Whitmer, and until next time, I hope you have a great day. Thank you so much for watching this clip.